Good morning, everyone. I'd like to start by thanking everyone for joining us. We have a packed house, and we're really very grateful for that. And I do understand that it's the beginning of the year, and that learning our views on the outlook this time of year makes sense. And as usual, I'd like to thank you for attending our seminars and our events. I'm going to go through a quick introduction of what we're going to see today. And of course, as usual, I'm always the boring guy who talks about the stuff that is in your packs. But this year, you should be aware of everything that we've given you, because apart from the presentations that we'll see today, we've included a form which you've probably seen before, but of course with the new data protection law, we do need to have you fully registered in our systems. And so the form, we do need you to fill it in and leave it with us on your way out if you want to continue to receive our reports and our invitations to different events. Also, and as usual, we've also included a feedback form. As we always say, we are always obsessed with improving the quality of our events, and so we find your feedback really valuable. So please hand that in as you leave as well. And also, because there will be several presentations, there's also a question card. And the plan is for you to write down your questions, and they'll be collected halfway through the session and then at the end. But of course, also, if you want to ask your question out loud, we can pass you a microphone and you can ask your questions then. But having said that, and getting into the topic at hand, as you know, I'm meant to introduce today's event. And I think today's event is not just because it's the beginning of the year, but I do think it's particularly timely, particularly the market side, because to do that we have our chief strategist, because we've had a year, which you'll remember 5 quarters ago, the world was plunging into a crisis again. Markets were slumping dramatically. And after that, we had a month of January in which markets began to rally. And last year was, at least from the point of view of yields and portfolio management, it was an extraordinarily good year. And so I believe that you must all be wondering what we might expect from this year. And that's why we have our chief strategist here, Karen Worth, who's going to give us that outlook on the world this year and what we think we need to do with portfolios, or how we need to construct those portfolios for the current environment. And then we'll talk about products. And on the products part, we're going to start with a fund, which, even though it's 5 years old, it's, I think, relatively new for the Spanish market. And I think that many of you are beginning to recognize us as the income firm, because we have a couple of funds in the market for over 10 years now, which are income products, and they've been quite popular and quite successful, not just because of the way the portfolio is constructed, but also because the income concept, I think, has become increasingly popular. And I think that a lot of you are using these products quite frequently. Having said that, and to complete that income product range, today we'll be presenting a flexible fixed income fund focused on income generation. It's what we call the JPMorgan Income Fund. And just to describe the product, it's similar to the other similar successful income funds, which have had very good yields, so from a well-known house, but ours similar, but with a higher yield. So I hope you will like it. And to talk about it, we have Andrew Norelli, who is the fund manager, and he's going to talk about that strategy, which he's been using for 5 years, as we've heard, with extraordinary results. We'll also talk about European equity, and that, of course, is nothing new to you because we have been talking about European equity in our events for many years. And in fact, we've been counting on Michael Barakos, who is our European equity chief manager from our behavioral finance department. He's been attending these events for many years, and I think most of you know him already. And the plan today is to present two funds, which you already know, Europe Strategic Value and Europe Strategic Growth. But the reason why we want to talk about these funds today is not just because we feel that 2020 could be a good year for European equity, but also because this range of funds, which are pure value and pure growth funds, respectively. So the name really speaks for itself and for its strategy, are celebrating their 20th anniversary. I think we're the only house that has a pure value and pure growth fund range with such a long track record. So again, that's why we have Michael Barakos with us today, and he's going to tell us about how the funds are doing and what his outlook for Europe is this year. And finally, we will be talking about ETFs. A couple of years ago already, we told you that we had launched our ETFs, that we had entered the ETF space, and of course, we're still there. You'll remember that our approach for ETFs was to try and deliver different active management strategies with an ETF format. And so that's what we're still doing. And to talk about that, we have Olivier Paquier, whom I think you've also met before because he's taken part in various events of ours these last few years. And he is the head of ETF distribution for Europe for JPMorgan Asset Management. So that's it for me. Let's give Karen the floor now, and she's going to talk about how she sees the world this year. And again, if you want to write down your questions as she speaks, write them down in those cards, and they'll be picked up halfway through the event and at the end. So having said that, thank you very much for coming, and I'll be seeing you later when we finish.
We signed phase one of the historic trade deal.
Tariffs on European Union products as
heightened tensions between the United States and Iran and what it means for the market.
Elevated geopolitical risks.
The world is a dangerous place portfolio.
We did not take action to start a war.
Clearly, the market has kind of maintained its trend.
An entire decade without entering a recession.
Recession, it's the R word.
Your growth slowdown.
A little bit weaker now.
You are finally going to be wrong.
The bears refuse to acknowledge.
We had the Fed on our side. European Central Bank President Christine Lagarde.
We stand ready to adjust.
Ready to adjust
for our operations.
All of its instruments.
As appropriate.
As appropriate.
Let's get Brexit done.
Sydney, Berlin, Bangkok, New York calling for action on.
Our climate is breaking down.
The European Green Deal Investment Fund.
Deeper into this ESG explosion. It's a broad term, but ESG.
Synchronized slowdown, tentative stabilization, sluggish recovery. Our first piece of advice is keep doing what works.
Good morning. There's a lot going on, a lot
us to discuss, as I think that video demonstrated. So, buenos dias, it's great to be here this morning. Thank you very much for your time. How do we put all this together in something to talk about for the next half an hour? I've put together this agenda. I'm going to start by talking about the cycle, because as investors, we base our decisions on the cycle. When it's early cycle, we want to take risk, and when it's late cycle, we want to take risk off the table. But where are we in the cycle? 18 months ago, we were all talking about late cycle, the fears of recession, a longest expansion we'd ever seen. And we were worried about a downturn. And yet here we are today, enormous optimism that this cycle has a lot longer to run. So where are we in the cycle? I'm going to cover that first. Of course, it's not just about the economics, unfortunately. Increasingly, people who have an economics background like myself are actually just talking about politics. And it's been the politics that's been the problem for us for most of the last 2 years. But again, the market is excited, it's happy, it's not worried about politics right now. Is that right? Is actually the US election, Brexit, other political risk going to come back to generate us volatility? The third thing I want to talk about is ESG and sustainability, because this is the start of a new year, but it's also the start of a new decade. And I think the ESG agenda is going to be the most transformational thing this decade. I think we have completely gone from a world where thinking about sustainability was based on whether you personally cared about climate change or about what was happening in society, from you considering this because of your personal preference. That world is behind us. There is now so much policy, regulation, stimulus, intervention coming from governments, regulators, and multinational bodies. That means if we are not thinking about this and how it's going to transform the macro landscape and the investment landscape, we're going to get caught out. So a lot of the work we are doing internally at JPMorgan is making sure we're ahead of this game. And then finally, of course, I'll put all this together with some suggestions of what we might think about doing with our portfolios. So I hope that sounds okay. No one's leaving, so that's a good sign. Where are we in the cycle? As I say, this really usually underpins how we shape a portfolio. Do we want to take much risk, or do we want to have risk off the table? That usually is based on our assumption of the cycle. And it's been a very long expansion, a record long expansion in the US, a very long bull market. But it looks okay. Don't worry, you don't need to look at the details and the numbers of this slide. You just need to know if it's blue or if it's red. This is a global inflation. Inflation is usually the indicator that tells us we're at the end of the cycle. So when economies grow too much, when they start to stretch the limits of their ability to grow, the warning sign usually shows up in inflation. And over the last 2 years, that was where the concern was starting to come from. Wage growth globally was starting to pick up. We were all watching those Friday payroll numbers coming out of the US and watching wage growth nudging up and expecting that to translate into inflation. But it's not there. There's not enough inflation. The central banks are worried that inflation is too low, that in fact it's got stuck. Japan keeps the central banks up at night. What the central banks worry about is that when companies get used to not raising prices, they just stop. And when they stop, it's very hard to get them raising prices again. And all of the central banks are worried about Japan, the Fed and the ECB. So the ECB, we had new stimulus last year before Mario Draghi handed over to Christine Lagarde, taking interest rates into deeper negative territory. Now, I've been presenting all around Europe in the last few weeks. I was in Germany last week, and I was asked by the person interviewing me, can you give us any hope that negative interest rates are going to go away? And the German audience, I'm not kidding, 1,000 people in the German audience did this to me. They were saying, please tell me negative interest rates are going away. And I disappointed the whole audience and said, I'm so sorry, they're here to stay. And the reason is, negative interest rates have 3 ambitions, but the central bank only tells you one of them. So what the central bank tells us, the ECB tells us, is negative interest rates are designed to make you spend more. They don't want you to save. And that's not really working, obviously, particularly in Germany, where actually the inclination is to save even more. So that's what the central banks tell us. What the central banks don't tell you is the other things negative interest rates are designed to do. Most importantly, to depreciate the currency. No central bank says this usually. It's not very neighborly. But you particularly don't say it when you know President Trump is quite keen on having a weaker dollar. So they don't talk about the currency effect. But negative interest rates are helping keep the currency low. The third thing that negative interest rates are doing are handing money to governments. Europe has very high levels of debt. But because these long-term government bond yields are coming down and down, it's making refinancing this debt much easier. And the numbers are enormous. 30 billion per year to the German government, for example, because of how low these interest rates have fallen and their interest costs have fallen. There's similar numbers here in Spain. But again, the central banks don't really want to highlight that this is what they're trying to do. But basically, I don't think Europe can afford a stronger euro. And I also think debt is going to continue to be high and will be difficult to finance. And for those reasons, I'm afraid negative interest rates are here to stay. I'm sorry. Of course, it's not just about what they've been doing with the policy rates, the negative interest rates here, the insurance cuts we got from the Fed. It's the fact that they're now, once again, expanding their balance sheets. Quantitative easing is back, and the markets didn't like quantitative tightening. And this was a really important development last year, particularly from the Federal Reserve. The Fed told us they've given up on the idea of normalization. Remember in 2008, when they started quantitative easing, they told us it was temporary. They were going to buy these assets, take them out of the market, but when things got better, they were going to put them back. They've given up. It's like a dieter who's given up on their ambition of getting smaller and buys a new wardrobe. They're just going to stay fat. And the central banks have conceded these assets are never coming back to the market. But given how big these purchases have been, look at the numbers here. We're up to 16 trillion. This is a big amount. This is big news for the markets. This stuff's never coming back. So the central banks are going to keep experimenting. I don't buy this idea at all that the central banks think they're out of ammunition. They will keep experimenting. The Bank of Japan, probably the furthest in the experimentation process, 25% of its purchases now are corporate equity, corporate ETFs. So that is going to continue to be a major influence on markets. Now, we could have a very interesting philosophical debate about whether this is good or bad and some of the long-term distortions that are going to come from this. I don't have time to cover that right now, but our fact of life as investors is this is going to continue to be a very dominant force across all markets. So that is the good news. I don't think we are end cycle. I don't think there's enough inflation. That tells us the global economy has capacity, and the central banks will keep working to keep this expansion going. So that's the good news I have for you this morning. I'm afraid the bad news is the politics still. The first event, of course, the biggest event that's going to happen this year is the presidential election on November the 3rd. We need to know 2 things to think about whether this is going to disrupt the markets. The first, who is President Trump's contender? Who's he up against? From the Iowa caucus, it looks like it could be Bernie Sanders. The market's not going to like that, I think, when that gets firmed up. The idea, the possibility that we could have this more far left-leaning person in office. So I'd expect as we get towards the summer months and it is more clear who that contender is, that's going to generate us some concern and some volatility. The second thing we need to know is, what is President Trump going to campaign on? And particularly, is it going to be this America First, very hostile agenda that we have seen from him up until recent times? So let's just look at the timeline from here. So on the right-hand side, I really think it's round about the summer, the market will focus on this issue of the presidential election. My colleague and I were just laughing this morning about how the market really can't focus on more than one thing at a time. And I really think come the summer, it's when we're going to focus on this presidential election. And I think that will generate us some volatility. How does President Trump campaign? Is it this more hostile approach? I think the good news about President Trump is that he realized over the course of last year that his trade agenda, his tariff agenda, was not going to just hurt China and Europe, it was starting to hurt his own economy. And that was posing risks to his own possibility of being re-elected. So the rule of thumb is, history tells us that incumbent presidents get re-elected as long as they don't have a recession. And he could see the data was deteriorating. Manufacturing was in decline. It was starting to broaden out. So he has realized it's in his own agenda to back away from the trade war right now. And we've seen the phase 1 deal. And that is him backing away. And that is good news. I do think that represents an internal understanding in the administration that it was going to prove problematic for the US economy. So I'd expect him to stay amicable for the next few months. I would expect him, even if China are not meeting their commitments, and of course the coronavirus will make it more difficult for them to meet the commitments, but even so, I think that we will see this trade agenda for the next few months remain fairly amicable. But again, as we get to the summer, does that change? I think quite possibly. The left-hand side chart shows, there is a lot of political support for the America First agenda. The US electorate believes that Chinese growth is built on unfair trade practices. They are also questioning whether the EU has unfair advantages. So will he come back to the opportunities he sees or the unfair practices in the EU? I think quite possibly. So I think we need to remain a little nervous about some of the headlines, or these days some of the tweets we're going to get from President Trump as we get beyond the summer months. Now, how is that impacting the economy? The main way the trade war damaged growth was because, understandably, I think, companies decided to stop investing. I mean, why would you invest when you don't know where your supply chains are going to be? And that's what we saw. We saw business investment on the right-hand side collapse here in Europe, turned over in the US. And when CapEx collapses, global trade follows. So that was the damage of the trade war. So my question is, even if the trade war is not escalating, even if it has de-escalated, do companies come back to investment this year? It's not obvious to me why they would. There's still a lot of uncertainty. You could have Bernie Sanders elected in the US and be facing much higher corporation tax rates. I'm afraid to say Brexit's still a problem here in Europe. My apologies. I'm so sorry about this. Of course, the UK has now left the EU, but we don't have that final partnership established. And the UK is still trying to achieve the impossible of having a close partnership with the EU, but not willing to be subject to EU rules and regulations because the UK wants to be sovereign. But that's impossible. So these negotiations are going to prove very, very difficult. So this uncertainty lingers, and I think that keeps us in a world where companies don't invest. Why would you invest this year? Wait till next year. see if things get better. So if CapEx stays weak, I think that keeps us in a slower growth environment. Now, Europe has been really hit by the slowdown in CapEx. Although the trade war was between the US and China, actually the damage was here in the Eurozone, because a lot of our economies are very manufacturing heavy, and we make capital goods. So that's where the slowdown was felt, and we saw that tremendous slowdown in exports from all the different regions. Now, I'll mention the coronavirus here at this point, because I don't know. Look, I have no expertise on viruses and pandemics. All I know is that China at the moment, to contain the spread of infection, is in a shutdown. They are blocking, my colleagues are having to stay at home. This is even in Shanghai. They are not allowed to move around. So the Chinese government has taken very strong and abrupt they've been very determined in stopping the spread of infection, but then China is not at work. Now, it's supposed to reopen next Monday if the spread of infection is contained. I don't know whether that happens, but all I know is that China now is the engine of growth. You know, we used to say when the US catches a cold, the rest of the world sneezes. We need to forget that now. When China catches a cold, the rest of the world sneezes. So we need China to come back online. So the key information I'm looking for in understanding the damage this coronavirus is going to do is, does everyone come back to work on Monday? We don't know yet. And then what stimulus does the Chinese authority implement to make sure that activity bounces back? Now, I'm pretty convinced Beijing are going to inject as much stimulus as required. They are very determined, and when they want to generate activity, they do. So I think that provides a lot of comfort. The question really is when they feel the infection rate is contained and people can start traveling and moving about again. And we just don't know at this stage. But the importance of China in the global economy now is essential, particularly for us here in the Eurozone. So that is a really critical piece of information. I think will delay the point at which the recovery will really improve this year. So I don't think CapEx is going to bounce back. I think the weakness in China pushes out the point at which the recovery comes through. The problem I have then is when I look at what analysts are forecasting for corporate earnings. You know, I always say that I'm always looking for friends who are equity analysts, because they're really happy. They're a really optimistic bunch. They always think things are going to be really great. So always equity analysts expect corporate earnings to pick up. We know that. That's a fact of life. That's their nature. They're happy people. But the pickup that's expected this year looks too optimistic. I cannot see the bounce in economic activity that's going to generate us these kind of earnings numbers across the world. It's a very impressive H2 bounce back that's the market's pricing in. And that makes me nervous, particularly because margins are under a lot of pressure, and that's not going away. We just talked earlier on about there's no inflation. Now, that's good for the central banks giving us low interest rates, but it's not good for profits because there's no pricing power. There's no top line. So margins are under pressure and sales aren't going to bounce back. I think this year is going to be a low earnings environment. And I don't think we're going to meet those analysts' earning expectations. So what takes the market higher from the valuations that we're at today? Because that is the problem. Last year, earnings didn't help take the market higher. So it's a valuation story. And if we look across the region, we can see the extent to which multiples picked up. Now, from depressed levels that we came into last year, admittedly, and nowhere's obviously extremely expensive. We know the US market is a little expensive relative to the rest of the world, but that's largely a sectoral detail. The US is more tech-heavy, And that really has been, we know, and we'll talk about that later in the session, the tech sector has, of course, been the star performer of this expansion. But everywhere else is sort of normal-ish valuations, not obviously cheap. So could we see a big multiple expansion this year? It's not obvious to me, given some of the political volatility we're going to see. So I think we need to brace ourselves for some moderate returns, for some mediocre returns, certainly nothing like we experienced last year. Now, that being said, we can't get too bearish here because we know we'd be, A, fighting the buyback story. This is one thing I think is really important for the European market. This is one detail I think we need to be well aware of. The US market has been strongly supported by buybacks through this expansion. Companies have been buying back stock, pushing up the price. And Europe has now caught the buyback bug. You can see in the last year, this increasing pace of buyback from European companies because debt is very cheap and they don't want to reinvest. So what are they doing with their money? They're increasingly buying back stock. And that really helps the market. It's less supply, pushes up the prices. I think it's one of the reasons the European market did okay last year. Didn't actually do much worse than the US market, even though the European economy had a really weak year. And I think that's the buyback story. So that's going to help Europe, I think, on a regional basis. But of course, the other thing going on in equity markets is suddenly we need equity for income. I mean, the world has gone completely topsy-turvy. We used to go to fixed income for income and equity for capital, and now we go to equity for income because it's very hard to generate income these days. And the person that's going to follow me next is fortunately very good at it for us at JPMorgan. But it's very hard in fixed income to generate income these days without taking on a lot of undue risk. And the equity market is increasingly part of that solution for where you go for income. In fact, if you're a European investor and you have a 50-50 portfolio, more than 90% of your income comes from the equities in your basket. So that's going to support equity markets, this hunger, this search for income. So that's one of the reasons I can't get too bearish. And of course, I'd be fighting the Fed, I'd be fighting the ECB, I'd be fighting the Bank of England, the Bank of Japan. They don't want these markets to go down. So I think it keeps us somewhat comforted about the scale of the downside, but nevertheless, I don't see enough earnings to think this is going to be a really upside year. And I think politics is going to give us some volatility along the way. Okay, ESG for a minute. The key thing I'm trying to stress to you here is the policymakers are going to give us a lot of things to think about in this space. So how many of you think that central banks are important for markets? Give me a show of hands. Who's still with me? Who's awake? Okay, most of you. Christine Lagarde, the new president of the ECB, has said that climate change is mission critical for the ECB. What does that mean? What does that mean she's going to do? How do they make it central to ECB policy? I don't know. The new head of the Commission, the European Commission, is very focused on a climate solution. So what I know is governments that are still signed up to the Paris Accord are way behind their targets of where they're supposed to be on CO2 emissions. So what they need to do over the next couple of years to catch up is some pretty dramatic policy. And I think what they're going to throw at us is going to dramatically change how we move about, how we produce, how we create a building, how we heat it, etc. I think we're going to see massive changes in the next few years to really accelerate the solution for climate change. But it's not just about the environment. Probably the best example of the S&G or the other components is data privacy. So How many of you get sort of shocked like I do when you open your phone and you're having a conversation with your husband or wife about a need to buy light bulbs, and then you turn on your phone and it's advertising light bulbs? It freaks me out. I hate it. I'm like, but the company's ability to get our information, share data, and use it to generate profits is really important for the profits of some companies, particularly these very highly valued tech companies. What if those data privacy laws change? That changes the outlook for earnings of these companies completely. So we have to be all over. The way we analyze Fed speeches and the way we analyze ECB speeches to work out what they're going to do with policy rates, we have to do exactly the same now in regulation, what they're planning to do on climate change. Because that's going to really affect how we should allocate assets. So just look at the exponential rate of policy that we're getting in this space. So this just demonstrates my point. There is a lot coming at us. That is going to grow the sustainable market. And a lot of the work we're doing internally in JPMorgan is about making sure we're capturing the information and we're using the information appropriately. So I think some companies are very focused on getting out products. We're more focused on getting the information and using the information and allocating appropriately. But this is really important. I really can't stress how much I think this is going to influence where we appropriately allocate capital. Okay, let's start to put some of this together. So markets are so optimistic. Even a shutdown in China at the moment is not stopping the markets wanting to go up. We're coming into this year with price to perfection. I am more nervous. I think it's going to be more of a tightrope act this year. I think the politics is going to generate us volatility, whether that's the US presidential election, whether that's President Trump coming back to the trade agenda later in the year, whether that's the saber rattling between the UK and the EU as the Brexit negotiations proceed. I think it's going to be slightly more difficult. I don't think it's going to be a strong earnings year, and I think we may experience more volatility than what the market has factored in right now. Now, I do concede it could be better than that. Maybe President Trump has completely realized that he should forget the trade hostility completely, focus on a strong economy, a rising stock market, and maybe companies behave in a way that I don't think they will. Maybe CapEx really comes back. Maybe. And if that does happen and the recovery is really strong, it will be a good year for risk markets because there is no way the Fed are going to hike rates. I cannot see an environment this year at which we're talking about tighter policy. So I concede it is possible. It's sunnier. I think it's equally likely, however, that it's more thundery. I think it's equally likely that President Trump does focus on the America First agenda, that the politics is difficult, that CapEx doesn't bounce back, that the recovery is not V-shaped. So what do? We've got some pretty big tail risks, I think, this year. Well, I think the core of your portfolio needs to be relatively balanced and thinking about some more defensive aspects within your equity selection. In our view, that's a focus on large cap rather than small. It's a focus on value rather than growth. This is a little bit more contentious, but our view is just that growth expectations will prove more cyclical when we go through a period of earnings weakness. And screening on quality, making sure we've got good companies who have not over-leveraged in this period of low interest rates. So screening on quality across both our credit and our equity portfolios. But I acknowledge the sun could shine, and therefore I think in that environment, emerging market equities would do well. I think they would see the biggest earnings bounce back, and I think they would see the biggest valuation uplift as well. So that's where the strongest returns would be. And certainly over the decade, I think that's where the returns will be. But equally, I want to think about the ballast. And this is where life is tough in Europe. This is where we have real difficulty thinking about our diversifiers. What do you add to a portfolio these days to provide ballast? Do you want to use German bunds? Do we still want to use treasuries? I certainly don't want to use UK gilts. What do we add in the way we used to? And we need to think across a broader range of diversifiers, including things like alternatives, where, okay, you suffer liquidity risk, but you can maintain some form of income and the diversifying properties. So, I'm a little less optimistic, clearly, than the market is at the moment. I do think it's going to be a bit more volatile. I do think at this stage we want to be thinking about something that's a little bit more balanced. But the income challenge is something I think you guys are going to be, and ladies, going to be talking about a lot this year. And so at this point, I'll hand over to Andrew Norelli. Thank you very much for your time.
Thanks, Karen. Those were some terrific charts in there. I learn something new every time I see Karen or one of her colleagues in her team present. They are the best in the business at the guide to the markets, and several of those charts that she used in her presentation are from that. So thank you, Karen. Terrific job. I've got a shorter time slot. I'm going to talk for 20 minutes. 10 minutes is going to be a very quick macro overview of the way I'm thinking about markets. And then the second 10 minutes will be a very quick discussion of the income fund, which is my baby, my pride and joy. I've worked on it for 7 years, and it's got some quite good momentum. Some of you in the room own it. Thank you very much for your trust and your confidence. So let's dig in. Everybody knows at this point that quantitative easing causes asset price inflation, but I'm going to try to tell you why, and then give you a peek under the hood at some of the real quirks that are driving liquidity in the market. And frankly, it's driving my short-term view, so we'll just talk through it. All right, this is my chart. The shaded area in the background is the Fed balance sheet size, and the purple line is the S&P 500. And every time the Fed balance sheet goes up, the stock market goes up. And during periods where the Fed balance sheet is shrinking, or during the pause between QE1 and QE2 and QE2 and QE3, stocks went down. So it'll take economists 100 years to prove that quantitative easing causes asset price inflation, but it pretty clearly does. Now, why is that the case? So the global stock of savings can get stored in only 2 places. Wealth is stored in 2 places, cash and everything else. An equilibrium between cash and everything else in terms of supply and demand is created by the price of assets. Now, quantitative easing is not helicopter money. It is not a distribution of cash into the financial system, because otherwise it would cause consumer price inflation, and we know that it does not. But it's not helicopter money. It's a giant swap of cash for assets. So $1 or €1 of quantitative easing is $1 more cash and $1 less of assets globally. Cash into the system and assets out. So that creates an imbalance in the system. And in order to restore the supply-demand balance between cash and everything else, the price of everything else has to adjust upward. That's how asset price inflation works. And generally speaking, asset price inflation is 5 things: higher stocks, tighter credit spreads, generally lower rates, lower volatility, and weaker currencies. And those 5 things are the components of financial conditions indices. A financial conditions index measures how expensive it is to borrow money. How expensive is it to raise capital for all borrowers in the economy? When financial conditions are more loose, lower on this chart of the Goldman Sachs index, it's easier to borrow money, it's cheaper to borrow money, whether we're talking about equity capital, debt capital, callable, non-callable, domestic or foreign. Generally, money is cheaper. And if you think about it that way, then loose financial conditions have a positive impact on financial performance. The economy should be faster if money is cheaper, all else equal. And that does turn out to be the case. So if you think about what does loose financial conditions mean for those 5 components, it just means markets are strong, markets are frothy, prices are high, expected returns for investors are low, but by the same token, borrowing costs are also cheap. So Goldman Sachs says that loose financial conditions in 2019 will have a positive impact on US GDP by about 0.5% to 1% quarterly in 2020. So there's a delayed but positive impact of frothy markets on the economy. And for this reason, and because of the phase one trade deal, we at JPMorgan have decreased our probability of recession in 2020 from 40% when we were staring down the barrel of a really rough and disruptive trade acrimony to 25% now, and it's actually probably even lower than that. But this liquidity provision by the central banks is going to continue. So it causes asset price inflation, and it's going to continue. Well, what does that mean for asset prices? It's still likely to go up. But the Fed doesn't want it to continue. In their perspective, they're done stimulating. But for a quirk in the balance sheet of the Fed, it is going to continue. So here's what the Fed balance sheet looks like. The asset side is mostly treasuries and mortgages and a little bit of repo, that purple sliver right there. Those are the assets that the Fed acquired in Q4 of 2019 to satisfy the demand for reserves by the commercial banking system. So the not QE in Q4, that's the repo. Now, this is what the liability side looks like. These two big blocks in the middle, bank reserves and cash in circulation, that's money. Everything else, other and TGA, is not money, all right? So what is the TGA, Treasury General Account? It is the United States Treasury's cash account. They deposit their money not in the commercial banking system, but they deposit their money with the Fed. And that's it, $400 billion. And when they deposit money with the Fed, it comes out of circulation. It is a liquidity withdrawal. So when Americans pay their taxes, or when the Treasury borrows money and then does not spend it, that money comes out of the financial system. It goes onto the Fed liabilities. Now, in the United States, if you're a taxpayer and you overpay your taxes in 2019, so you're due a refund, you file your tax return as soon as you can in 2020 to get the money. And if you owe taxes, then you wait until April 15th to file your taxes. So in between February and March and April, the TGA shrinks because the Treasury pays out tax refunds to all the Americans that file their taxes. So the TGA is going to go down from $400 billion to $200 billion in the next 2 months. Even if the total Fed balance sheet stays flat at $4.3 trillion, the reserve balance is going to go up dollar for dollar with the TGA. That's $100 billion per month for the next 2 months of quantitative easing that the Fed does not control. So even if they want their balance sheet to stay the same size, it's going to grow. The money in circulation is going to grow. So we're going to get more liquidity. So given that our probability of recession has declined, Fed is pumping liquidity, phase one trade deal is signed, why is it that we are still pricing cuts in the Fed funds curve? So our compliance department needed these slides 2 weeks ago. That's one cut price. Now it's two because of the coronavirus. So we're pricing 2 cuts, even though asset prices are very high, financial conditions are loose, recession probability has declined. Last thing on balance sheet. You know something weird is a dirty little secret, if that translates, a dirty little secret? When the Fed buys bonds, the price goes down. And when the Fed sells bonds, the price goes up. It's very strange, but it always happens. Okay, let's look. This background shaded part is the same as the first chart, the Fed balance sheet over time. But this time, the purple line is the 10-year yield. Look at it. Every time the balance sheet increases, the 10-year yield goes up. And then when we had the pause between QE1 and QE2, yields went down. Same thing here, yields went down. Here, more QE, yields go up. Fed shrinks their balance sheet, yields go down. Fed grows their balance sheet, not QE. Look at that, yields went up. It's the opposite of what you would expect. So if anyone stands on a stage like this and tells you the supply of treasuries is going to be big, so yields are going higher, they're going down. It goes the opposite. It'll take economists 100 years to prove why this is. I have some theories. I can't explain it in my time allotted, but just trust me. When liquidity increases, risk-free rates go higher. All right, so I told you we're pricing cuts and we shouldn't. I told you the TGA is going to shrink. which gives more liquidity. And I told you yields go up when liquidity is injected. So this is my chart. All right, it's kind of busy, but the gray shaded area is the 5-year average of the TGA balance through a calendar year. So this is a seasonality chart, all right? And there it is. February into March, the TGA always shrinks because of tax refund payments. The dotted line is the average. The blue line is the 10-year yield. Seems to go up. Black line is where we are today on the TGA, all-time record balance. All right, so I'm bearish treasuries and generally bullish risk assets, at least over the next 2 months, because it's too soon for this election stuff to happen, as Karen was talking about. But nonetheless, we're going to get a liquidity injection. Now, I haven't mentioned really the coronavirus yet because I had to do these slides 2 weeks ago. This was my view at the beginning of the year, and we had to modify it along the way as the assassination of the Iranian and the coronavirus and, you know, Trump impeachment, Bernie Sanders winning kind of the Iowa caucus. So we had to evolve. But because markets have been so resilient in the face of those 4 macro threats, it seems to come back to liquidity as what is driving the markets. And we know that China is going to increase their liquidity as well and already has started in response to the coronavirus. All right, that's the near-term macro backdrop. Now, the income fund. All right, JPMorgan Income Fund's trying to do 2 simple things. First, to pay a high yield-like yield with much less volatility. And secondly, to pay out that income in predictable distributions. So, yield on the income fund in euros is 3%. It's about 5.25 in dollars. Comparable to that of euro hedged high yield and way more than core fixed income. Yet the volatility, realized volatility on the income fund for the 5.75 year life is 3%. Around 60% of the volatility of high yield, less vol than core fixed income. And actually, I'll show you in a minute, the investor experience is even better than that. And then on the right-hand side, very predictable dividends in dollars. The euro dividend has declined because of hedge costs have increased over time, generally over the life of the fund. So JPMorgan Income Fund, how we do that is our value proposition, and it's got 3 components. First, Income Fund draws upon the combined expertise of our global fixed income platform. That's not Income Fund specific. That's true of every multi-sector fund at JPMorgan. But the next 2 are Income Fund specific. First, Income Fund seeks and achieves real risk reduction through genuine diversification, harvesting uncorrelated or negatively correlated risk premium from throughout the global fixed income landscape. So in that sense, it's kind of a throwback product. It pays homage to traditional Markowitz portfolio theory, and it does so rigorously. We try to build portfolios the way they teach you in college to build portfolios or in grad school. Most people don't, because it's quite hard. And then the third thing is the income filter, where the best ideas from our global platform are optimized for maximum distributable income. A couple key characteristics: 5.25% yield in USD, but that's not our target. We're not targeting a yield. We're maximizing the yield subject to a risk constraint of 4 to 6% volatility over the cycle. That's forward-looking VAR, usually a bit higher than realized volatility. So we picked that number on purpose. A bit more risk than the Barclays Ag, but much less risk than high yield in emerging markets. And we want to give you all the benefits of those riskier asset classes. So those 2, yield and risk, and then we have at least 35% investment grade securities in the portfolio at any time. Right now it's about 50-50. So high yield, low vol, and with significant investment grade holdings has been quite a compelling proposition for investors at end of cycle. I want to de-risk and I want to preserve my income. This is what you do. If you move from a blended income product into a fixed income product, 4 things are going to happen. Your dividend's going to go up. Your dividend is going to be more stable. Your volatility of the NAV and the whole portfolio is going to decline, and you're going to give up your equity downside. The only thing you miss is equity upside. Okay, this is the most important slide in the pack. We cannot succeed in delivering a high yield-like income stream with much less volatility if we fail to source textbook diversification. We must find uncorrelated risk premium to combine in the portfolio. Okay, the height of each bar here is the total yield of a representative security from each sector that we hold in the income fund. There's a couple things to notice. First is that the yield on those columns is a little higher than the benchmark, mostly. That's okay. These are actual holdings in the income fund. The second is that the colored sections which make up the contribution to yield from each risk premium, they tend to be concentrated, 2 or 3 risk premium in each sector which make up the whole yield. The point is to harvest all of them and recombine them in such a way that the expected return is preserved, but the total portfolio risk is reduced through diversification. And the end result is a total portfolio yield that's similar to the components, but the source of that yield comes from a much more balanced array of risk premium. Now, these are real numbers. We do this calculation every couple of months to show investors. So the sizes of these risk premium do change based on our asset allocation and what's available to us in the market. But the general appearance of the fund as a whole, this kind of rainbow of risk premium, that's always present. And that's a critical outcome of our portfolio construction process. I'm asked all the time, Andrew, is this just a barbell product where you take distressed credit on one side and treasuries on the other and just pay the average yield in the middle? No. Not a barbell product. Turns out the average yield of each of our sectors is plus or minus 150 basis points of the portfolio yield. And most of our holdings in this histogram here, where the yields are bucketed, most of our holdings are between 3% and 6%. So it's not a barbell product, and yet it is a broad mix of credit, emerging markets, and securitized products, and some of those securitized products have credit risk and some do not. All right, one thing I haven't yet mentioned is that the income fund is very actively managed. Probably one of, if not the most actively managed product in JPMorgan fixed income. And we've got 4 main levers to pull: duration, curve risk, asset allocation, and the overall risk-on, risk-off profile of the portfolio. This is duration. And usually when fixed income portfolio managers show a duration chart, they shrink the scale so that small changes in duration look like big changes on the chart. Okay, minus 2 years plus 8 years, all right? This is a full scale. The solid line is our duration, and it's the sum of longs above the axis and shorts below the axis. In 2018, our major competitor, which is run by some very, very good, very talented portfolio managers, what they wrote and what we wrote publicly about the macro view was very similar. They said quantitative tightening is going to affect markets, it's going to affect the economy, and it's going to have to get reversed. We said quantitative tightening is going to affect markets, it's going to affect the economy, and it's going to have to get reversed. The same. We approach markets similarly, as far as I can tell. I don't know them well, but they seem quite keyed in. But our positioning was much different. So for us, navigating quantitative tightening meant acknowledging that we were going to go through periods of shifting correlation between treasuries and risk assets. Sometimes we'd have risk off with higher treasury yields, which is super painful for fixed income investors who use duration to hedge. Then we'd have risk off with lower treasury yields, and then we'd have a central bank dovish course correction where risk assets would rally and yields would go back higher. So we try to navigate that. We anticipate that through the year. So entering 2018, low duration and low risk, around 3 years headline. Then the Italian political crisis in May of 2018, where correlation flips back. You get lower rates in risk off. So we extend duration back to 6 years. Then In August 29th, 2018, Jay Powell gives a bullish, dovish speech in Jackson Hole. Normally, when central bankers give dovish speeches, investors think that means lower rates. No, not in the 3 phases of quantitative tightening. So we cut our duration back down to 3 years in August of 2018. And then we go to November when Jay Powell said we're a long way from neutral, that policy gaffe. And we extend our duration out to 6 years. And that was super helpful for us in December of 2018, which was otherwise a risk-off month. You remember that Christmas time big equity sell-off? So in December of 2018, income fund had a positive total return, and that 6 years of duration was super important for it. Now, somebody's probably knows this over here. The shortest we have been on December 31st, 2019, and 10-year yields have rallied about 40 basis points since then. So how have I not killed myself? Well, suffice it to say our position does not look like that, and it hasn't for a while, and I'll leave you with this. I've got a pain threshold, okay? Scale of 1 to 10. 1 is euphoria, 10 is I'm suicidal. If my feet hit the floor out of bed in the morning and I feel like a 2, feeling really good, I have the wrong position. It's making money and it's making a bit too much too quickly, and the position is becoming consensus and need to exit. If I wake up in the morning and my feet hit the floor and I'm a 9, I'm about to shoot myself, blow my brains out, I also have the wrong position. Too painful. It's wrong. Get out. So I wake up in the morning and I'm a 7, pretty miserable. That is the way that I have to go through my professional life in order to succeed. It's like pretty terrible. But okay, so in January, first couple of weeks, Iranian guy gets assassinated, yields are rallying. We had a couple of 9s in there. So we change. We modify position when it's not working. And I don't really make light, I don't want to make light of the emotional impact. Like, I'm a human being, I'm not a magician. So moving this line up here in the middle of January was quite difficult to do. And as you might have seen the last couple of days, rates are starting to reverse again. So this is difficult. We're far from perfect, but our intent in moving duration is to always reduce risk in the portfolio. So when duration has positive correlation with risk assets, you need to be short, and that's much less often than when duration has negative correlation with risk assets, in which case you need to own it. So that is why you see shorts in gray below the axis and longs in gray above the axis, which is pure treasury duration, usually by treasury futures. This is the proof statement. Realized volatility of the income fund in blue and Barclays high yield index in gray. Oops, sorry. Barclays high yield index in gray. And I said at the beginning that the volatility of the income fund was about 60% of the vol of high yield on average, and that's true. But you'll notice when markets are calm, tranquil, the income fund and high yield both have the same volatility, and it's really low, about 2%. But then when markets get chaotic, the vol of high yield spikes, and the income fund is much better behaved. So when you need it to have less vol, it has much less, a fraction of the vol of high yield. These charts show the same thing. On the bottom, there's been 4 periods of risk off in the life of the income fund, and each time the drawdowns have been much less pronounced than high yield or a 60-40 stock bond blend. And yet the total return over time, which is the top chart, the red and the blue are similar, which you would expect because the yields are similar. Another dirty little secret in fixed income is that all the return comes from income over time. The best thing that can happen is you get paid back on time. So the performance numbers are compelling. And again, I thank you very much for your time and your business. Thank you for having me. I'm Andrew Norelli. Next up, Michael Barakos.
Buenos dias. It's always a pleasure to be back in Madrid and see so many familiar faces in the audience. I'll be talking about 3 things today. First of all, the case for European equities, European equity beta. Secondly, which investment style should you be in? The million-dollar question at the moment. Should it be value that's really struggled of late? Should it be growth that can't do any wrong? Or perhaps it should be both. And I'll go into that in a few minutes. And then we're going to talk about two of our strategies, our Europe Strategic Value Fund, our Europe Strategic Growth Fund, which actually have their 20-year anniversary next week. So they've been riding through the test of time, both in value markets and in growth markets, and they come up very strongly in terms of both the alpha generation and the risk-adjusted returns. That's their strategies that I've been actively involved in since their inception 20 years ago. So let's start with the case for European equities for 5 minutes. I want to take you back about a decade ago, probably when I first came out to Madrid to market European equities. Doom and gloom. We were at the end of the global financial crisis, the beginning of the Eurozone crisis. We made a statement then that we felt that for the next decade, equity returns in any equity region, particularly in Europe, would be some of the best equity returns over a decade in a century, even though it was very obvious at the time, and it transpired, that growth rates would be very weak in terms of the macroeconomic growth rates. And that's because two things are really crucial for returns of any asset class in the medium to long term. The valuation you pay for that asset class, everything has a price, and the rate of change of expectations. People focus a lot on levels, and 10 years ago levels were very dire everywhere in the world, particularly in Europe. But it's the rate of change of expectations that drives prices, right? What's in market expectations versus the reality. And lo and behold, as you know, any equity region's done phenomenally well over the last decade. European equities delivered about 10% per annum, which if you compound up over just 10 years, gives you 160% total return. I mention that because it's very important through everything I talk today and generally this year to remember those two things around valuations and rate of change of expectations. It's also important to remember that equities are volatile. The last 10 years has been a phenomenal decade for equities anywhere in the world, including Europe, but they come with volatility. In most of the calendar years, you'll see a drawdown, high to low, of double-digit percentage down. And too often clients sell at the low and buy at the high. It's very important to ride that wave. The average drawdown over 40, 50 years has been about 15% on the average calendar year. But in European equities, the average annual return is 8 to 9%. So that's very encouraging. Where do we go from here? I agree with Karen. Valuations in Europe ex-UK equities are roughly fair value. We haven't got that cheap argument anymore that we had 5, 10 years ago. However, I think in the UK market, valuations are still attractive. I think rate of change of expectations will still surprise positively. And I think very importantly, technically, investors are very underweight European equities. In the last 13 years, we've only seen 3 years of net inflows. There was a very nice sweet spot between the summer of 2013, about a year after Draghi gave his do whatever it takes speech, to the summer of 16 with that Brexit referendum result, where we saw very strong inflows into the equity region. But leading into that, 16 years in a row of outflows, and more recently in the last 3.5 years, up until about 3-4 months ago, horrific outflows from European equities. So this is, despite being the longest bull market in the last century, 11 years now, I'd say it's one of the least loved bull markets. Investors have not been participating in it anywhere near as much as they perhaps should be. And I think that's very bullish in terms of positioning from here. If I was given €1 for every time I heard about the markets being in late cycle globally and in Europe over the last few years, I'd have enough euros to buy you all a Cerveza this evening. But that's really important to appreciate. Positioning's very extreme. Valuations are fair, but they can get expensive. More importantly, the rate of change of expectations look good. I think it's very important as well, and this is behavioral finance at its best, to frame returns for European equities. A lot of focus on last year and the fact that European equities did a 28% return. a very strong return despite all expectations, and a lot of that coming from valuation re-rating. But if you frame it on the last 2 years, what you'll actually see is in Europe, roughly half the appreciation in European equities has come from earnings growth, and roughly half has come from valuation re-rating. So there is an underlying earnings story there. If we touch on the macro just for a second, again, think about the rate of change of expectations. 6 months ago, PMIs in the manufacturing space, in Germany, in China, which is very important for Europe because Europe exports a lot to China, looked horrible. 38, 40, 42, that kind of level. That's a real-time gauge for business activity, but the rate of change is what drives equity markets, and the rate of change has been very positive over the last 6 months. And what we're paying close attention to, and Karen touched on this in her presentation, is the employment rate across Europe. The unemployment rate has steadily been coming down. It's almost halved, if you look at the left side axis, over the last 6-7 years, almost in a straight line. Despite that, whilst there is some wage inflation coming through, it's still pretty benign, which implies that we're not necessarily yet at full capacity, and is again bullish for the economy, bullish for European equities. Just to wrap up before I go through the investment styles and strategies to play those investment styles, I think it's really important to appreciate one very powerful valuation argument for European equities, and that's just how strong the free cash flow yields are for European equities in particular. In absolute levels, they match other markets like emerging markets better perhaps than developed markets, but for me it's the relative game that really matters. So the opportunity cost of investing, you've got to put your money somewhere. You can be in sovereigns yielding negative in Europe, even if you're in corporate bonds. So the same company, but just different areas of the capital structure, you're not really getting any return for your investment. That spread to corporate bonds is still around 5%, and that kills the spread in every other region. And as Karen said, European corporates last year finally are starting to arbitrage this. They were super risk averse, and they had bigger problems, to be fair, versus US corporates who started arbitraging this from 2009, 2010. But last year, for the first time since pre-global financial crisis, net share buybacks across Europe, about 1.5% to 2% of net issuance. And we expect that to continue this year and beyond. So very happy to take any questions at the very end of all the presentations on the outlook for European markets. Let's move into investment styles now. I think obviously the perception is that the last decade's all been about growth, and in aggregate that's true, but there's again been a huge amount of volatility. You've had periods where value has also performed well, and I think it's very dangerous, particularly at this stage when value and growth is diametrically opposed. I mean, Andrew mentioned just now his scale that he uses to judge his emotions every day. If you're a growth manager, you're a 1 on that scale, and you've been a 1 on that scale for a long time. If you're a value manager, a genuine value manager with genuine value exposure, it's a really lonely place at the moment. You're sticking your neck out, no one else really is with you, and you're losing all the time. You're probably an 11 on that scale, okay? Super suicidal. But this is where experience can play a role. We've been running our value fund for 20 years. We've been in periods like this. The height of the Eurozone crisis, the height of the global financial crisis, the height of the Brexit referendum result, and the knee-jerk reaction in the next 2 days in terms of value. And we know what happens when that normalizes again to an extent. It's very sharp, it's very severe. The good news for value investors today is value spreads are even wider today than they were in those 3 periods I just mentioned. And they were pretty scary periods, right, at the height of those crises. They're almost as high, in fact, as the height of the tech bubble. And I never thought I'd ever see that. That's when I started my career in '99, and that was proper Looney Tunes. Everything I learned in university went out of the window. So that's quite a statement. Value globally is top decile wide in terms of spreads. In Europe, it's top percentile wide. And bear in mind, it never feels comfortable when value is about to make an incredible return. There's always a million reasons I can give you not to make that value trade, okay? But it's about what you're paying for the investment you're making. And I think now, and for a while actually, you're getting more than compensated for the perceived extra risk you're taking with the value investments. And as you can see, empirically, in the medium term, you get a massive positive skew to those returns. When you get those value returns, they're not just double the long-term averages, they're triple, quadruple, quintuple the long-term averages. And rarely are investors in that space. All the investors I meet, understandably, have a growth bias in their portfolios. It's just a debate of how big that growth bias is. And that's worked really well, but I think it's dangerous from here. Growth on the other side, when we're talking about predicted or historic growth, looks very expensive to us. What's more important to us in the way we run our growth fund, which I'll touch on in a minute, is on looking at unanticipated growth, i.e. determining what's the actual realized growth. But when we look at these historic and prospective or forecast growth rates, yes, they worked very well last year. They work well once or twice a decade as an investment strategy, but long term that destroys value as an investment strategy. Investors in the long term overpay for the comfort that growth provides. It's very comfortable being growth at the moment. It's very comfortable. There's only good stories around it. But the premium you're paying is just way too much. And actually, you're not getting much of a growth differential for that premium that you're paying, which I think is very bizarre indeed. When you look at quality, which often goes hand in hand with growth investing, financial quality looks expensive. It's an insurance premium. Our definition of quality, which is not just financial quality, but also looking at things like management quality, proxied by capital discipline, earnings quality, proxied by are the headline earnings backed up by genuine free cash flow generation, actually looks pretty fair value. So that for us is very exciting when you complement trying to target unanticipated growth within our growth strategy. Just to wrap up on the investment styles with some interesting micro observations. A lot of what I've talked about so far has been top-down. Let's see what's happening in the marketplace recently. And I think this really goes to show just how extreme positioning is. I've given some examples of that at the macro level, but at the micro level you can see it as well. Consumer staples is a sector with over a 10% weight in the MSCI Europe index. The majority of the consumer staples disappointed in the last earnings season. The last earnings season being the Q3 earnings season. We're only about a quarter, a third of the way through the Q4 earnings season. That's really important because the disappointments were actually quite small. 1% organic sales miss, 2% operating profit miss. They weren't big disappointments, but because they're really expensive sectors, everyone's hiding them, and they're massively overowned, mega cap by European standards, consumer staples names, Unilever, Henkel, Reckitt, Danone, AB InBev, we can mention some others as well, we're down 5, 8, 10. In the case of AB InBev, 12% on the day of the small profit warning. That is very unusual, and it just tells you how extreme positioning is and how expensive that classic growth area of the market is. On the flip side, autos is a sector where it's very difficult to find a single positive news story. Structurally very challenged sector, but that sector is being priced, the incumbents, to go out of business in 5 to 6 years' time. We think that's way too extreme, okay? And everything has a valuation. That sector got down to 5 times earnings 4 months ago, and the same kind of intrinsic asset valuation-based metrics you saw at the peak of the global financial crisis. 0.2 times book value, 0.2 times sales. Extremely cheap. You're getting compensated more than adequately for closing your eyes and starting to invest in some good names in that sector. And I think for me, a case in point is this Peugeot-Fiat merger that was announced a few months ago. Typically, when you're getting an in-market merger, and this merger is actually quite complementary, there is obviously overlap in terms of cost synergies, but a lot of complementarity as well in terms of geographies and models. Normally, you'd be happy if you have a 3-5% earnings enhancement from cost synergies. If you're really lucky, you're talking maybe 8 to 10%. This merger is generating 45% earnings uplift. Think about that for a minute. The sector's got so cheap, the stocks have got so cheap, that simply by putting two companies together and taking out overlapping costs, you're immediately getting a 45% uplift in earnings, hence a similar decrease in the PE rating that was already cheap in the first place. That, for me, is a screaming signal of just how cheap some of these deep value sectors have become. So how can we exploit those investment styles within investment strategies? Well, the first point to make around our Europe Strategic Value Fund, our Europe Strategic Growth Fund, which hit their 20-year anniversaries next week, is that they've always been genuine growth and genuine value funds. We will never have style drift. We always like to do what we say on the label. These are all 100% European stocks, and we're trying to maximize your exposure for every euro you invest with us to the growth style and to the value style. That's a really important first point. So any extra return is genuine alpha generation from bottom-up stock selection. It's not us taking a top-down binary decision to style time. The next important point is that we've always been very clear for 20 years, and the market's starting to understand this now, being forced to understand it, that our value proposition has to be to generate genuine alpha, okay? There's no good us saying we did a great job, let's say, on our growth fund versus the broad market when it's a phenomenal growth year like last year. We've always shown our performance versus the value and the growth benchmarks, and what you can see since inception is, you know, you can get very efficient, low-cost access through smart beta products to a passive value index, a passive growth index, the purple lines. But our funds have done, as they should do, significantly better over 20 years. And if you can compound up that 300-400 basis points per year that they do in excess of those style indices through that good bottom-up stock selection, over 20 years, that compounding effect is incredible. And that's what we're excited about going forward. Just a couple of minutes on both funds before I wrap up. The European Value Fund launched like the Growth Fund in February 2000. Interestingly, when we launched it, no one wanted to know about the Value Fund. The whole market wanted to know about the Growth Fund. That's the style that was in fashion. But you know what happened over the next 5-6 years. Value had its strongest run globally, and particularly in Europe, since the Great Depression. This fund was the best performing European equity fund on the street, bar none, over the next 5 to 6 years. And remember what I said about value spreads. The value style now is almost as distressed in terms of extremities as it was at the height of the tech bubble, something I never thought I'd hear myself saying. Over the last 10 years, we've delivered second quartile returns in an environment where values really struggled. Remember, we're style disciplined. We're one of the few value funds out there that has a genuine value style, still today. That's fine, because our job when value's out of fashion, I think, is just to try to keep our head above water. We've managed to generate a little bit of alpha in the years where value's out of fashion. Where we really lock on to excess returns, and why this fund is top decile since inception 20 years ago, is in the periods where value does well as a style. Versus that value style, those green bars, we do significantly better. And the wider the value spread extreme, such as the height of the tech bubble, the better the excess returns. So that's no guarantee for performance going forward, but it's not just empirical evidence, it's the real fund returns and the same managers running that fund for 20 years to be able to live those kind of excess returns. Clients can trust us to do the right things and hopefully do a good job of stock selection within value. We also have the growth fund alongside that, 5-star Morningstar rated. The last 10 years has been a phenomenal growth environment, and hence we should have great growth returns because we're doing a much better job versus that growth index. We formally introduced our definition of quality into this growth fund 8 years ago. That was the only philosophy change we've had in 20 years. Since we've done that, this fund is the best performing growth fund on the street. Okay, and has won a number of awards exactly for that. I just think I'll have a quick comment around the US technology sector, which obviously is a massive part now of the US index. There's a perception there that Europe can't compete in terms of growth ideas. First of all, we have a lot of small technology companies which are great alpha generating ideas for our fund that are inputs into those big technology stocks. Secondly, we have a growth sector of ourselves, of our own, which has done even better than the US technology sector over the last 18 years. We've cherry-picked it to be nice to technology by taking the bottom of the tech bubble burst, and we've started this price chart at the beginning of 2003, not at the beginning of 2000, and yet still the price performance of EU luxury goods, which is pretty much a monopoly we have in Europe versus a lot of the customers coming from Asia and to a lesser extent America, but whether you look at price performance or earnings, done even better than technology, which I think is quite an eye-opening statement. To wrap up on time, I think it's important to appreciate that the pictures for Europe equities is improving. It's that rate of change of expectations, remember, that drives prices. The asset class remains out of favor, massively out of favor, particularly European equities, so technically under-owned. Strong free cash flow generation is a powerful value argument for European equities. And remember what the corporates are doing, those share buybacks. So a 4% dividend yield roughly on the index, plus last year 2% capital appreciation from share buybacks. You've got 6% last year, and I think this year as well, by the way, because those dividends are very sustainable and growing, before you even worry about underlying fundamentals and capital appreciation. We think there's a strong case for value. Value spreads are top percentile wide versus history. A strong case for growth as well simultaneously. At the moment, bond yields remain very low and growth to become a proxy on the bond yield, given that it's a high duration investment style. And we have two funds that can deliver fantastic returns versus those respective styles with a 20-year history, 400 basis points of alpha per annum that compounds up very nicely. And we're meticulously looking for those value and growth investments at all times. I'm very happy to rotate the portfolios to find the best ideas. Look forward to Q&A, and thank you very much for your time.
Thank you.
Buenos días a todos.
Good morning, everyone.
Good morning. I see there's a bit of a swap within the audience. I do see familiar faces this morning. For those that I haven't met, my name is Olivier Paquier. I head the distribution team for ETFs at JPMorgan Asset Management. Super delighted to be here with you guys this morning. A lot of you will probably think ETFs are easy. And I would say it's actually quite the opposite for me, because we have so much to say, so much to tell you about, what makes us different. And a bit like what Andrew said about his funds, ETFs are, in a way, my babies. So I had to pick and choose. This is a difficult task. But as we saw with Karen this morning, there's various political risk, economic tensions, trying to make the most out of the various dynamics. We heard about technology. Agreed with you, Karen, I think you're over there. Technology drives me crazy as well. So there's that element. There's ESG, a very big trend in the industry. And the beautiful part for me is that ETFs actually fall into the crossroads of all of those, I would say, dynamics. The good news is that at JPMorgan, we do have some differentiating either factors, sectors, tilts, and ETFs in general that can help you build stronger, better, or more improved portfolios, I would say. Before I jump into what we do and into the range, I wanted to share with you a few elements about the ETF market and about our product range. The product range that we have launched about 4 years ago in the world and 2 years ago in Europe has grown tremendously, which is a great sign for me, because it shows that we have filled up a gap that was in the market. The big thing we're doing that nobody else is doing, and I think that's the one message I would like to deliver to you, is that we do actively managed ETFs. We have regular plain vanilla ETFs that everybody knows or has heard about, but we do have some differentiating exposures with real portfolio managers, real human beings behind. I often say I've never seen an ETF in my life, but I've seen portfolio managers. And I'm going to pick and choose a few of those to tell you to take examples. We have grown tremendously. In Spain in particular, this is a key market for us. We have grown quite fast. In Europe, the numbers that we have on all of our UCITS ETFs, we have 22 UCITS ETFs. We have gathered about $3 billion in a matter of 24 months. So once again, this is a sign that you guys in this room and the clients that we have in Europe as well had found with us something they haven't found with anybody else on the market on ETF specifically. A quick word about the ETF market today. In the ETF world, we have $6 trillion under management. To be fair, when I prepared that presentation, I was really not I would say I just couldn't put my head around $6 trillion. So to give you some comparison, $6 trillion is the equivalent of the market cap, the entire market cap of the FANGs. We love to talk in tickers in the ETF world. And so the FANGs, just to be clear for everybody, it's Facebook, Amazon, Apple, Netflix, and Google. If you combine the market cap of all of these together, which is the largest market caps on Earth, you end up with the AUMs in ETFs. This is also 3 times the size of the hedge fund industry. So what I would like to say is that ETFs are not a small market. They're not a small part of the asset allocation decisions anymore. They're fully into the portfolios. We see that with all of our clients, whether they use ETFs at 5% of their allocation up to some 100%. It's interesting to see the evolution of that market to me. There's 2 explanations of the growth of that market in the recent years. The first one is fixed income ETFs. The very first fixed income ETF rose in 2005. And since then, the fixed income exposures through an ETF wrapper have completely exploded. And the second aspect, where we have pioneered at JPMorgan Asset Management, is actively managed ETFs. I think these are 2 growth elements that explain the ETF evolution. Why do clients embrace ETFs? I don't have the pretension to have all the answers, but I will invite you to look into the bags that were handed out to you. We have conducted, at the end of last year, a global ETF study with our client base. So institutional investors, private banks, asset managers, among the largest on Earth. You will have, per region, the current allocations and the future predictions of the allocations of our client base. And I would say that the decision to allocate in ETFs in general relies on 3 main elements in that study: the simplicity of the product, the transparency, which is shown behind me, and I think what is important as well, the flexibility to very swiftly change the asset allocation, rebalance a portfolio. We all live, I personally believe we all live in a world where we have controls in place, compliance departments, risk departments. I know a bunch of you have to go through that as well. And usually ETFs fall perfectly into that as a nice complement to mandates or mutual funds, because there's a daily transparency, it's publicly available, and you have the real-time evaluation of the product as well. So I'm not going to spend too much time on this, but just I think the wrapper itself, the vehicle, has historically been around passive, and it's not only passive anymore, it has tremendously evolved. On the chart behind me, I know it's a lot of information, but I've tried to put the realm of possibilities of what you can do in an ETF. So across various asset classes, equities, fixed income, some alternative exposures, that's what the whole market can produce. I started my career on ETFs 17 years ago. So that makes me probably one of the dinosaurs of the industry in Europe. And when I started, most ETFs were in the first column behind me, in light blue. They were on equities, and they were usually on the first line. They were on in a passively managed manner. So it was ETFs on the S&P 500, ETFs on the Euro Stoxx 50, ETFs on the MSCI Europe, certain sectors. That was, I would say, the past and what started and kick-started the ETF market. Right now, the ETF market is expanding into various directions. You have heard probably a lot of smart beta exposures through ETFs. We call them strategic beta. It's the same thing. And more recently, about 2.5 years ago, we have pioneered the market, the ETF market, with actively managed, fundamental, not rules-based exposures, which is the very last line, the bottom line behind me, of what you can do in an ETF wrapper. You have to keep, when you do that, you have to keep the same attributes. You have to keep the daily transparency. You have to find some market makers that bring a liquidity, either on or off exchange, and you have to find partners that are able to do that. Where we felt extremely comfortable is that we are fully embedded within JPMorgan as an ETF activity, which means we don't have such thing as an ETF PM. It doesn't exist within JPMorgan. We have portfolio managers, and they either manage passive exposures, smart beta exposures, or actively managed exposures the same way they manage a regular fund. So I think this is the strength of what we can offer. And considering the scale of our firm, we did focus on what I call 2020 pricing. So we are aware of competition. We are aware that you have the choice. I personally feel that the European market is the most competitive market in the world in the ETF space. So you're lucky to be set in such a competitive space. It's positive for you, and we have decided to bring forward actively managed exposures with index-like prices. I had to make a choice. I told you ETFs are my babies. I had to make a choice. I was probably on to take the examples of the portfolio managers earlier, I was on a 9 when I had to make a choice because it kills me to make a choice. I could spend hours talking about some of our ETFs, but I chose for this journey today 3 ETFs. The first one will be an emerging market debt type of exposure to address some of the idiosyncratic risk that we may have seen this morning with Karen. The second ETF will be a cash type of solution through an ETF wrapper. And the third ETF will be on the equity side, and we're going to see together how we can maximize a portfolio exposure producing index plus or enhanced, if you will, exposures with actively managed expertise. If you allow me to go to the very first ETF I would like to talk to you about, I told you we speak in codes and tickers. So in the ETF world, we have an ETF that's called JPMB for our JPMorgan Emerging Market Debt UCITS ETF. All of our ETFs, of course, available in Spain are UCITS and are physical ETFs. I think that's important as well in terms of risk. And what we've done is that we have piggybacked on our expertise within JPMorgan Investment Bank, who are the market leaders in the world on emerging market indices. So right here, I'm talking to you about a smart beta ETF that passively tracks a modified type of index to address some of the idiosyncratic risk of the emerging market debt. When we think of emerging market debt, we think of a first concern, which is the country-specific risk. We know that there's some risk in the emerging market space. Not all countries in emerging market have the same risk. I just, reading on my notes, I just thought 3 striking examples over the past years. The example of the Ukraine back in 2015, Argentina, various times over the past 20 years with the restructuring of their debt, and more recently, Venezuela, where they had a few bumps, I would say, up until last year, which generated tremendous underperformance in passively managed type of portfolios. So the idea with that product is to step out of the sort of market cap or a debt issuance weighted type of exposures. So we don't want to be exposed, we don't want to expose our clients to the largest debtors on the market. We want to avoid the falling knives and to make sure that we're addressing those risk, those primary concerns. So what we've been doing is that we have embedded within the MB world, so the global emerging market debt world, a few risk filters that we believe in a systematic way can help our clients build better portfolios. The first one is the liquidity. We have a liquidity filter with minimum maturity, minimum issuance to guarantee that the trust of the market when a country issues in dollars on the markets is actually there. The second element is using a relative, I would say, risk measurement, which is called the duration time spread, DTS, another code, which will eliminate the most risky countries. So if you look at the emerging market world, emerging market debt world, you've got about 70 countries that issue debt today in dollars, in hard currency, but not all of them undergo the same risk. So when you do that and you apply some liquidity filters, some risk filters as well as I've described, then you remove the riskiest countries. Looking at my looking at my notes, Venezuela, for example, has not been into that index in a systematic manner since 2011, as an example. So I think it's important that our clients get compensated for the risk they want to take on the emerging market debt, but not in every kind of way, and avoiding, once again, the falling knives. The second element, we think, in terms of concerns, when we think of emerging market debt, we think of the quality of the ratings, and we think of high yield in general. That index will rebalance in an automatic manner the investment grade and the high yield portion to reach about a 50-50. It can move to 40-60 exposure, so you increase the quality of your portfolio. In the end, you end up with probably about the same yield, and the same diversification than the global MB, but you end up with a 2.5 or 2.59% excess return versus the regular market cap weighted indices. We believe that this systematic way of, and smart beta way of addressing those emerging market debt stories can be helpful for you. The second type of ETF I wanted to talk to you about this morning is our ultra short suite that enables a lot of our clients across the globe to address the issues of a low rate or sometimes a negative rate environment, as we know in Europe. There's no magic. We don't solve all issues, but we feel it's one of the solutions to help you reposition some of the cash in your portfolios or in your clients' portfolios if you're a distributor. And this has been the blockbuster of our range globally, either in Asia Pacific, in Latin America, in the US, and in Europe with various currencies. I'm talking to you about the gray zone that is, or not gray, but purple behind me, which is between 6 months and 1 year of duration. We're not talking about money market funds. We're not talking about the short portion of the curve, so 1 year plus. We're talking about that gray zone that we call managed reserves at JPMorgan, and we are the world's leader in managing this type of asset class. We manage overall through our global liquidity desk about $600 billion of those assets on behalf of clients. And once again, we have embedded our ETF activity within each investment desk and decided to offer to our client a dedicated solution to address that portion of the curve. The idea is simple. The idea is to maximize the yield while lowering the duration to a maximum as well, not taking too much risk. We're not talking AAA here, but we're talking about corporate bond exposures in various currencies. So behind me, the ticker JEST refers to the euro exposure, since we are in Europe and in Madrid. And once again, the idea is to give you as much yield as possible. So I know we're not giving a positive yield on this one, negative 18 basis points net of fees, but it's still a solution that's better than the negative interest rates than the ECB. We have a dollar version with dollar corporate issuances, for example, that delivers about 90% of the yield of the entire US curve with about 10% of the duration. So another type of solution that enables our clients to build, I would say, more diversified and better portfolios. The third element I would like to talk to you about is our REI suite. So you have a product list as well in the bags that were given to you. REI standing for Research Enhanced Index. The idea there is also very simple. The idea is to give you a step up, if you will, or a slight outperformance comprised between 25 and 75 basis points net of fees versus a plain vanilla in a market cap weighted index. And I think that is as well the next generation of ETFs that is hitting the market today. The idea is to combine a fundamental approach, so we're talking about an actively managed portfolio with an index-like attributes, if you will, so low tracking error, low fees, and ultimately low tracking difference. I think this is important for our clients, and this type of solution really helps driving the market forward with ETFs. Portfolio construction starts just like any portfolio construction at JPMorgan. We start with fundamental approach, fundamental research. We have a research process that is 30 years old on this type of exposures. So it's not new, once again, in an ETF, at JPMorgan, it's new in the ETF wrapper. We start there. We forecast the earnings of every single underlying that we are analyzing, depending on the exposure. We have various ETFs on various exposures, as we will see. And based on our research, we rank them in quintiles. With those quintiles, the portfolio manager behind can build an asset allocation itself and do some stock picking. The idea is not to give any bias to the fund towards a sector, a region, an industry, etc. The idea is to be extremely like an index. So index-like with an ESG overlay. We also believe that being ESG compliant is a major driver for the future. We want to be ready for now, in the present, so that ETF range encompasses an ESG overlay. So, for example, hard-coded into the portfolios, our portfolio managers on those exposures cannot buy tobacco, thermal coal, and controversial weapons. So it's debatable, it's just that it's irrefutable that those three elements are killing people, or participating to killing people, and we wanted to make sure that those were not embedded into the portfolio. The result is pretty nice and pretty consistent over the years. I know it's a lot of data behind me, but the result is extremely, I would say, comfortable for us, because in a consistent manner, we can drive outperformance that varies between 25 to 60, 75 basis points, depending on the exposure. And if I take the example in green behind me on the Europe version of this RAI, Research Enhanced Index, we have an outperformance just since the beginning of the year of about 40 basis points due to the stock picking of the portfolio managers and due to the absence of tobacco companies, which actually underperformed the market tremendously over the past few months. I'll stop there. I know it's a lot of information. I just wanted to come back to this 9-box matrix, because I think it's the most important of my presentation, where my message to you is that I think we can do with ETFs much more than just passive, much more than index tracking. We can also embed and give in a full ETF wrapper with the liquidity and the flexibility and the transparency another kick. Thank you so much, and I think we're opening it up to the Q&As. Por acá.
Bueno, pues pasamos a la parte de preguntas. Voy a empezar.
Okay, to start the Q&A session, I will ask for a show of hands if anybody have questions in the audience. Would you like to use a microphone or fill in one of your question cards? Hello? There's a question over here. No questions from the audience? Apparently not on the microphone, so let's read the questions we got in our first card. So Karen, first question for you.
We will see inflation in Europe anytime soon?
No.
No?
No, I mean, I am. So I talked about Japan as being the big fear for a central bank, because I think what we've learned over the last few years is companies do get very used to a pattern of inflation. And as I say, what Japan taught us, I think, is that the usual way we think about inflation, as in the economy gets tight and unemployment gets low and therefore inflation shows up, that breaks down when companies just get very used to a certain rate or lack of inflation, and you expect your competitors to do the same, and you start to profit maximize on other alternatives rather than raising your prices. And what does concern me about Europe, and I think this is a real challenge for the ECB, is the stability of core inflation. I mean, there's been a few little wiggles around, but largely core inflation has been 1% now for about 6 years. So I think companies are getting used to 1%. Every year they wake up, now it's the year, time to change my prices, and they're getting used to 1% rather than 2%. So I do think that's a real challenge for the ECB, is sort of dislodging, convincing everybody to aim for a higher rate. I'll at this point say, because I do think this could be really important for markets. At the ECB and at the Federal Reserve, and the Federal Reserve will come first, they're having a conversation about inflation getting stuck and how they can shift, dislodge everyone to this higher level. And one of the things that's coming out of that is an ambition to target an average rate of inflation. So in other words, if you've had a period of inflation that's too low, the central bank will tell us they are aiming for a period at which inflation is too high. I think that's coming. It's going to come from the Fed this year. Eventually then, with some resistance and always a little bit later, the ECB will formalize that as well. And I do think that that's going to be important for markets because, you know, we all put our hands up and said we know the central banks are really important. This is going to be the central banks telling us they are aiming for something above 2. So I think that when that momentum starts to gather, that could be another tailwind for markets. But I think the Fed are going to have an easier job of generating that than the ECB because I do think we're getting a little bit stuck. And it comes back to, unfortunately, one of the key conclusions I made of these negative interest rates are here to stay, because I think the ECB, if anything, is going to be under pressure to do more to shift that inflation rate up.
I actually think inflation would rise if they hiked rates. I know that's sort of heresy, but cutting rates more isn't going to help. It will, as Karen said, be a tailwind for markets, but remember my charts, asset price inflation and consumer price inflation are not the same thing. So they have created asset price inflation they shouldn't want anymore, but stronger doses of the same medicine or asking for the patient to get even healthier than, you know, that's what the average inflation target means. I want you to get even healthier. But that doesn't help you get healthy in the first place. So I don't think it works. I think eventually they will either hike rates through the tiering mechanism or outright hike rates just to see what happens.
Okay. Karen.
We encourage healthy disagreement at JPMorgan, as you say.
She thinks they'll never hike.
That's good. It's a healthy debate.
Another question for you, Karen.
Okay.
Do you believe that due to the coronavirus, okay, in China, China will be able to meet their commitments with the agreement with United States?
It's a good question. I think the answer is they were always going to really struggle to hit that 200 billion number. I think the coronavirus is almost a very easier. You can understand why I'm hesitating to use some of these words. It will be easy to explain to the US why it's away from the targets. And we've already heard, maybe you missed the news of the last couple of days, President Trump has already acknowledged that it's going to make meeting those import targets pretty challenging and is already giving a little bit of leeway. So that aspect of the virus doesn't worry me. The key thing I'm focused on is when is China back to work? When does China reopen? And if that's not Monday and it's pushing towards March, then I think we have a much greater impact on the global economy.
Okay. And Another one for you. There are many for you. And
Sorry, guys.
Well, there are some for them as well. And do you believe that Brexit is already on the valuation of the market?
I actually think UK stocks are going to have a better year this year. And that's three reasons. One is that international investors had two sources of political risk when they were thinking about UK assets. One was Brexit, but the other was Jeremy Corbyn, the leader of the Labour Party, and his very market-unfriendly practices. And although Brexit risk is lingering, Corbyn risk is gone. So I think that starts to entice international investors. The other thing is, 70% of earnings for the FTSE 100 come from outside of the UK. So if this global recovery gets some traction, then that should help the earnings of the UK market. And then finally, as a key thing we've all talked about today, this desperate need for income. And one of the charts that I showed you was investors coming to equities for income, and the UK market is one of the higher dividend payers across the equity space. So I think for those three reasons, investors will be coming back to the UK market in a way that I don't think at the moment is in valuation. I think at the moment investors are still worried that an appreciation of sterling could be too problematic for earnings, but I think sterling is going to stay stuck where it is. So for that reason, no, I think there is upside for UK stocks.
Okay. Andrew, it's your turn. Well, let me read the question because it's in English and it's a little bit long.
Okay.
Okay. You mentioned that you are long credit. Okay. What do you think about the increase in leverage and mature credit cycle when yields are going to rise, according to your view?
Yeah.
Okay.
That's a great question.
Yeah.
So I actually believe that the concentration in over-leveraged corporates exists in two places: in the BBB investment-grade corporate market and in the bank loan floating rate market, and not in high-yield corporates. And as a result of that, our investment-grade holdings are really low in income fund. So we launched with 15% investment-grade corporates. Now it's 4%. And most of that is bank capital, and we have no loans and no CLOs. So I do agree that leverage is stretched, and for a while I thought that stretched leverage could be the cause of the next recession or crisis, but I no longer think that, because the levered companies are making attempts in IG corporates to delever. So Anheuser-Busch InBev is a good one. For a long time it had the same leverage ratios as a single B high yield, and it did retain its BBB, and it is delevering. So if and when we have the next recession or problem, IG corporates and loans are going to underperform other credit markets because they are over-levered. And so I'm trying to avoid them. So the barbell of, the combination of high-yield credit, treasuries, and securitized credit is going to outperform IG most of the time, I think.
Okay. Another question, Andrew. Can you explain when the spread depot repo in US will be corrected and how?
It pretty much has been. The main repo problem in the US happened in September of 2019 when repo rates, all overnight rates, including the Fed funds rate, began to creep higher. And for a couple of days, the Fed funds rate did print outside of the Fed's corridor. So they publish a corridor for the policy rate, but it's really only a floor system. There is no cap. So they can floor the rate, but they can't cap it. And so effectively, that told the world that the US commercial banking system needed more reserves. So you remember my slide up there that had the Fed balance sheet, and on the liability side there was bank reserves and cash in circulation. Cash in circulation is paper money. Bank reserves are basically digital money. So they really are fungible. In fact, vault cash, physical paper inside of a bank vault, counts as reserves, not cash in circulation. So it's totally fungible. So we have this concept of required reserves and excess reserves. But the border between those two is determined only by the antiquated concept of a reserve ratio. And the United States has not been a fractional reserve banking market in over 100 years. So so that split between required and excess is anachronistic. It's from a bygone era. Really, the split between required and excess is much, much, much higher. And the Fed doesn't know exactly where it is because the amount of reserves that each bank needs, the amount of cash that each bank needs to hold, is dependent on their own regulatory situation. So JPMorgan, as a huge bank, has more conservative regulatory constraints than a mid-sized regional bank in the US. So there's no precise amount of reserves that the Fed knows the system needs. They have to watch demand for reserves to know when there is a shortage. And last quarter, when money market rates of all kinds began to blow out, it just meant that demand for cash in the commercial banking system was rising and was above the demand. Demand exceeded cash in circulation and reserves. So the Fed, if they had not addressed this problem, we would have had a massive risk off, but they did, and quickly. They weren't real public about it, but the repos that they did and continue to do and continue to grow and did over year end really did address the problem. So as a result, reserves have grown and the demand for more repo financing is starting to decline. So one of the differences between that and quantitative easing is that in QE, the Fed forced more cash into the market. And in Q4 of last year, the market pulled cash from the Fed. So it was a push versus a pull. But as I said in my remarks, the distinction is irrelevant when you want to think about how does it impact markets, asset price inflation, and the economy. So the short one-sentence answer to your question is it's finished, it's done, it's resolved.
Okay. Another question for you, Andrew. How would you compare your fund with a Pinko income?
Oh, man. Okay. God. You knew that wasn't a plan. Somebody actually wrote that, didn't they?
Yeah.
Okay.
Have it here.
I drew the short straw at JPMorgan, which means I feel, I'm biased, but I feel I have the toughest job that exists in fixed income because my competitor is basically like the world's best mutual fund, right? Biggest, best. They're super talented. They're formidable competitors, and they don't make mistakes very often. So it is an enormous challenge, but they have the same challenge that I do. We are trying to squeeze as much income as possible out of a market that doesn't offer very much. Prices are high, expected returns are low on virtually everything. But there's more than, it's another Americanism, there's more than one way to skin the cat. Doesn't work. Okay, so we have the same challenge, and they've arrived at success in a certain way that I don't really criticize. We are trying to arrive at the same outcome in a different fashion so that the market becomes a duopoly rather than a monopoly. PIMCO's approach is to highly leverage their portfolio and generally, with the exception of their EM holdings, have pretty high quality securities. So they have leveraged high quality, securitized, low volatility securities quite a bit, and then their market risk is all in emerging markets. That has a concentration to the US housing and consumer and to EM. So if either one of those things becomes a problem, because they've levered their fund, it can be a big problem. Now, what we have done in JPMorgan is use only modest amounts of leverage through the Treasury market, Treasury futures, and otherwise construct a portfolio using all of the fixed income landscape to genuinely try to find prices that move in opposite directions. It's okay if all of them go up at the same time, but what we really want to avoid is all of them going down at the same time. And the criticism is always, Norelli, fine, what happens if all correlations go to 1? We go into the credit crisis, all correlations 1. Well, actually, it's technically possible that every bond in the portfolio could go down in price at the same time, but it's really, really remote. So if I have big chunks of my credit holdings going down by 50%, let's say, a huge credit crisis, do we really think that treasuries are also going to go down by 50%? No. It's really hard to get correlation one between risk-free assets and risky assets in a credit crisis. But here's a more complex example. I have securities in the portfolio called interest-only mortgages, inverse floaters, where the coupon works like this: 5% minus LIBOR. So as LIBOR goes down, the coupon on that bond goes up. It's really hard to make the price of that bond go down when the Fed is cutting rates. Do you think the Fed is going to cut rates if we have a credit crisis? Yes. Coupon on this bond goes up. So that's what I mean when we're trying to construct portfolios where it's really, really hard to break it. Now, if Iveson was sitting on this stage and you ask him the same question, tell me the difference between your fund and JPMorgan Income. He'll say, oh, income fund at JPMorgan is full of high yield. Why would I own high yield? So there's always something to poke holes in. I have 24% high yield. That's not that much. We can hedge it, we can be short, and we have all this other stuff in the portfolio that's going to go up in price. It's just two different ways to skin the cat.
What I heard is that you have much better performance.
No, well.
So you are all.
I don't believe in trophies for investing.
If you want to, it's fun. Okay. Well, next question. It's for Michael. Okay. Don't you think that what it is really cheap today can be even cheaper in the next few months due to the different market circumstances, low rates, market environment? I mean, for example, banks.
Sure.
Yeah.
Well, and I can give you plenty of other examples as well. Yeah, for sure. I mean, when you look at value spreads in the marketplace, which is the best, empirically the best lead indicator of when the value style should work well or not work well, it doesn't predict what's going to happen today, tomorrow, next week, next month.
You don't have the crystal ball.
Don't have the crystal ball, but it's, more importantly, it's a good indicator in the medium to long term, right? So can things get cheaper? Sure. However, bear in mind what I said, value spreads in Europe are top percentile cheap versus history. That is, very, very, very extreme, okay? Almost the same extremities as the height of the tech bubble. That's the most extreme you've had it in 20 years. So, of course, things can get cheaper. Of course, you're banging your head against a brick wall trying to make the argument for value at the point of maximum payment. I get it. But I think you've got to try to take a medium to long-term view. And I reiterate, emotionally, it always feels uncomfortable. It's always a very lonely place, and it needs a lot of mental toughness and mental fortitude to pull the trigger and make the investment. But forget about the alpha generation argument. Let's just go with the risk control argument. When I see clients' portfolios having a growth bias, and the only debate is how big the growth bias is, typically, I meet very, very few clients across Europe or across the world who have a neutral bias, let alone a value bias. Isn't there mileage in at least bringing in that growth bet when you see value spreads are so wide? I tell you, when I came into the industry in 99, people were talking about any value stock, which was basically the old economy at the time, anything that wasn't TMT, going out of business. And you're not dissimilar today in terms of the extremities of the statements being made. People are talking about entire sectors. I mentioned the auto sector going out of business. That's pretty extreme stuff. And when the fundamentals don't support those arguments, of course things can get cheaper near term. But I think you've got to, as an investor, try to take the medium to long-term view and appreciate that you're getting more than adequately compensated. This is like a once or twice a decade opportunity for value that you don't get very often and is always proven empirically through time to make you incredible returns. Remember that positive skew to value. It's, triple, quadruple, quintuple the usual return to value. And that's why value is such a powerful style. The hit rate's not particularly good, but when it works, it really works, particularly because no one's in it.
Okay. Thank you. Michael, another one for you. Do you believe that Europe is losing the tech revolution against US and China? Or
Yeah.
What's your opinion on this?
Well, I think you've got to distinguish between what the market capitalizations are of tech stocks and what the actual underlying innovation is within the economy. So in terms of market capitalization, definitely. Our technology sector across Europe is a fraction of the size of the technology sector across China or broader Asia or America for that purposes. I think we've also, and it's a big debate we're having internally, a thematic debate in terms of what does it take to create more innovation. When you've had small pockets, small clusters of innovation, you've got a good technology example around the University of Cambridge in the UK, a good example in Scandinavia as well, where the regulations and the laws have allowed innovation. Once technology companies get to a certain size, they tend to take away from Europe and move out to where the cluster effect is a lot more powerful in Silicon Valley in America, right? So even when we have rare examples of innovation, that's moving away once a company gets to the kind of like unicorn size of 1 billion valuation. I think the politicians slowly but surely, as always with Europe, are understanding this, are going to take measures to address this in terms of encouraging innovation, giving tax breaks, trying to create those similar cluster effects. But it's going to be a long-term process. It's going to be a multi-year process. Having said that, I'd again reiterate in terms of the market capitalizations of companies we have, they see phenomenal appreciation. And bear in mind, as an investor, you can hold positions in stocks even if they're not in the index or they're very small weights in the index in terms of market capitalization. We've seen technology stocks in Europe go up tenfold in many examples in the last decade, just like they have in America. So we can still find the investment opportunities. It's just in terms of market capitalization, a small subset, but in terms of breadth of investment opportunities, there's plenty to go for. If I just say something on banks as well, sorry, because you asked it as part of the previous question. Obviously, European banks have big issues, have had big issues for over a decade now. The deleveraging of Eurozone banks only really started, surprisingly, in 2012, 2013. Whilst we're not expecting banks to massively outperform from here, unlike when we came here in the summer of 16, I think it was autumn of 16 specifically, we don't think they're going to significantly underperform either. I think there's a lot of focus on the fundamentals and how tough some of the headwinds are. For instance, the interest rate environment is something that rightly often gets mentioned, but a lot's discounted in the price again. The banking sector overall in Europe is trading at a small discount to tangible book, which means that the markets believing there's going to be value destruction into perpetuity, which feels too aggressive. And I think it's interesting just to look at this morning's news flow, right? You've had banks all across Europe, very different geographies, DNB in Norway, UniCredit in Italy, Raiffeisen in Austria, which is basically Eastern European exposure, all come out with decent results, but they're all up 5% today. Just another example, because positioning is very extreme and expectations are very low. And versus expectations, the banking sector actually was the biggest earnings surprise in the Q3 earnings season. And to date in the Q4 earnings season is looking like it will be the biggest surprise again. So again, remember what I said, it's about the value you pay for something, and everything has a value, and the rate of change of expectations.
Okay, well, I'm coming to the technology thing. The performance of your tech fund doesn't show that Europe is losing any race. So congratulations.
Yep, I think it's our best performing fund over the last 20 years, even better than value and growth.
Yes, exactly. Olivier, there is a question for you as well. Don't worry.
No me digas.
No te pongas triste que hay pregunta.
Don't be sad. There is a question for you.
Themes and risk, okay, for the ETF industry in the coming years.
Can I take the Brexit question from Karen? No, it's a great question. So there's one that affects the ETF providers, so us, and there's, in my view, one that affects clients, so you. And it's quite easy. The first one is regulation, and the second one is technology. So regulation, we have undergone tremendous regulatory changes, especially in the ETF space, because we're cross-listed, we're multi-registered everywhere in various jurisdictions. I think in Europe we're registered in 18 countries, so we talk to 18 different regulators on our ETFs. It's actually much broader than what we do on funds, and we are listed on 6 stock exchanges, just in Europe. I'm not even talking about what we do in Mexico and Asia with our European ETFs. So the regulation is challenging for us. One of the big things that will affect the way you look at ETFs lies on us, which is how do we get organized, as an example, under MiFID II, to consolidate. We call that the tape consolidation, which doesn't mean anything if you're not in the ETF business. How do we consolidate all the liquidity data that is available on ETFs? Because the big thing in Europe is that ETFs are not traded on exchange. They're usually traded by professional investors, OTC. So everybody goes out of the exchanges. That's the effect of MiFID I. So it gets cheaper and it's less transparent, and so everybody likes it. But I think in the coming months, technically, and years, we're going to have to consolidate all of that data, making sure that this is available, and this is one of the big themes of the regulation. On your side, I think what is going to make a difference, and we observe that in other regions of the world, is the technology. ETFs are the only products in the asset management industry that are actually valued in real time. So they fall beautifully with the new distributors, the new banks, the new apps. So I've discovered there's even apps that are not banks and players, and you can trade ETFs. And I don't believe we're there in Europe yet. I don't believe the new generation, the millennials, will trade ETFs from their app right now. We're not there yet, but I think this is the direction that everybody's taking. We had huge, at JPMorgan, we had huge inflows and I would say success in the US with these type of distribution or new distribution means led by technology. And I think in Europe, this is going to be the next big thing. Insurance companies are changing their distribution models. They're opening up to ETFs a lot, the same way that the discussions I had 10 years ago with private banks who didn't open up to ETFs, and now there are. So, you know, the means to distribute ETFs are changing, and I think technology will play a huge portion into that. We haven't talked about another big word, which is blockchain today, but blockchain is part of the ETF industry. We are right now looking at a change in the delivery and settlement of equities, fixed income exposures, but also ETFs. So pretty much when you in the future, in the near future, when you will buy an ETF, you will have an instant delivery and settlement, not having to wait for 1 day or sometimes 2 days. As one of our big boss said, we think ETFs are also the future.
Okay, thank you.
It was a long answer.
Sí. ¿Hay alguna pregunta más?
Do we have any further questions? If not, I would just like to thank you for your attendance in the hope that you found today's conference interesting. I hope you've kept some notes and some good ideas to help your clients. So thank you very much and see you next time.